Ever feel like your credit card bill has a mind of its own? One month it's fine, the next it's a monster. Or you're eyeing a car, but the loan payments keep changing? There's a secret force behind this, a small group of people who are basically the DJs of your financial life, and you've probably never heard of them. They're called the Federal Open Market Committee, or FOMC. 12 people who meet 8 times a year to set the most important number you don't know, the federal funds rate. Think of it as the base beat for the whole economy. Their job is to keep the party going without it getting out of control, walking a tightrope between stable prices and making sure people have jobs. So why does a rate for banks matter to you? Because that base beat creates a financial domino effect. When the FOMC changes that rate, it directly hits the interest on your car loan, your mortgage, and that monster credit card bill. It also decides how much your savings account actually earns. They raise rates, borrowing gets pricier. They lower them, that dream car looks more affordable. And the stakes are huge. If this economic DJ gets the vibe wrong and raises rates too high, they could crash the whole party, triggering a recession. But if they keep rates too low for too long, we get an economic fever, inflation, where everything gets expensive fast. It's a high-pressure gig where one wrong move affects millions. So who decides interest rates? Not a wizard, but a committee trying to balance a massive economic seesaw. And now you know, it isn't just boring financial news, it's the soundtrack to your wallet. Understanding the rhythm helps you make smarter moves and maybe finally tame that credit card monster.